Let's look at a mutual fund example in return for 2020. The worst performing areas of the market last year were energy, financials, utilities, and real estate. If you were to look at an allocation model, those four areas of the market make up about 30% of an S&P 500 equity model. So think about that. Those four areas, or 30% of your account, lost money last year. My simple question is, why did you own it? Because it's diversified, because it's optimized. That's what an allocation model is. But 30% of your money lost money last year. Let me take it another step further. Let's say that you have some fixed income, or you have some bonds. You have a portfolio, again, that's 20 to 30% bonds. So you may have half of your account, or 50% of it, in underperforming areas of the market and or in bond funds that are losing money or not even keeping up with the rate of inflation. So half of your portfolio has lost you money or is not making you money. That's why your account's underperforming. At Strong Tower Wealth Management, we don't own bond funds. We only own cash and equities. We currently don't own any international. Well, that doesn't mean we're not diversified. It just means that the international player is on the bench and he's not good enough to replace a player that's on the field. Isn't that how it should be? Own areas of strength, avoid areas of weakness. Let's look at an example. Let's drill down a little bit deeper into the typical asset allocation model. If we were to look at the 11 industry groups, and that's what our industry basically breaks everything down into, is 11 groups: technology, healthcare, consumer cyclicals, industrials, basic materials, consumer non-cyclicals, telecom, financials, utilities, real estate, and energy. Now we're going to look at the 2020 performance of each of these sectors from last year. And you'll notice that, again, 7 of these sectors did reasonably well, above 10% to 55%. Now you'll notice also that financials, utilities, real estate, and particularly energy didn't do very well last year. But if you look at the typical S&P allocation model, and it's probably what you have as well, financials made up 13% of that account, utilities made up 5%, real estate was 8%, and energy was at 5%. Now if you total those up, folks, that's 31%. That's a third of your money in areas of the market that have lost money. Now if we look at it from a pie chart standpoint, that 31% lays out like this. So 31% of the money allocated within this model lost money. Now at Strong Tower Wealth Management, we discuss relative strength and momentum investing. All that is we want to take the allocation or the money from the underperforming areas, or stay away from the weaker areas of the market, allocate that money to the stronger areas. So we're overweighted to the stronger players on the field. We allocate that money, and this is 69% of this portfolio. Now, doesn't it stand to reason that we take 31% of our money that is in underperforming areas of the market, we allocate it to the stronger areas? Of course, we may have to change that from time to time or tweak it as leadership changes. Doesn't it stand to reason that your performance should be better? As we discussed in another module about owning bond funds or fixed income, let's say that not only did you own these areas of the market, but let's say for a conservative or moderate portfolio that you had an additional 20%, maybe even 30% in fixed income or bonds. Let's just say bonds. So let's say from a conservative portfolio of 30% and another 30%, you have 61% of your money in either underperforming areas of the market or in bonds that are not even keeping up with the rate of inflation. Do you see how the other 40% here, roughly, while it may be positive, it's struggling to support the rest?